Children, after reading the various concepts related to national income, let us now study the methods of estimating national income. Today's class, we will be discussing about the circular flow of income that you have studied in the past, identify the three methods of calculating national income, and then focus down on value-added method, which is also called as the production method. We will understand the term value-added with the help of examples, and finally, we come to the process of calculating national income via value-added method. Then we also focus on what are the precautions to be taken in calculating national income by this method so that we do not come up with wrong calculations. And finally, we see its application in the form of numericals. As I said previously, we have three methods. They are the production method, income method, and expenditure method. All these three methods are three different points of views of looking at the flow of national income. As we can see on the screen, and yes, remember children, we are talking about the two-sector economy where the household and the production sector exist. We can relate all the three methods of calculating national income with the circular flow of income in a two-sector economy, which we have already studied in the past. We have seen in the circular flow of national income in a two-sector economy that the production units hire de facto services from the household, for which they make payments in terms of compensation of employee, rent, interest, and profit. This is what we can see on the screen. Factor payments move from production sector to household sector. Household sector uses this money to purchase the goods and services produced in the production sector. Thus, the money generated in the production sector goes to the household sector, and the entire money then flows back to the production sector. Let's speak in terms of phases. Production. It refers to the value addition which takes place in the production unit. Suppose there's a baker in the production unit who purchases sugar, milk, and flour worth rupees 10,000 and converts it into sweets worth rupees say 15,000. There is value addition worth rupees 5,000. This is what production means. Now, the phase of production in a circular flow means the process of value addition by the producing sector. In this phase, income is generated in the production unit, but it doesn't stay in these units. From the production phase, production units distribute this income generated to the owners of factors of production who were responsible for creating it. From the viewpoint of the household, these are factor income. Thus, the phase 2 of circular flow, there is generation of income as a consequence of the production of goods and services in phase 1. Now, value addition is converted into factor income, and this is the income method angle. This is the second phase of the journey of income where income travels from production units to households, and we label it as income distribution or income method of calculating national income. We now enter the final leg of circular flow of income where we see that income also does not stay with the household. The household spends on goods and services produced by these units, causing expenditure. Thus, in phase 3, there is disposition or expenditure of income as a consequence of the generation of income in phase 2, which is the third angle and is called expenditure method of calculating national income. These expenditures generate demand for goods and services in the economy. This again causes production of goods and services and consequently the generation of income. There is a non-stop flow of production of goods and services, generation of income, and disposition of income, each flow chasing the other flow, which is why it is called a circular flow. Considering the three phases together, we find that in a two-sector economy, production that is the value of goods and services, is equal to income generated, which is again equal to expenditure, which is also called as the triple identity. As we can see on the screen, it brings us to the three methods of estimating national income: the production method or the value added method. We are talking about the first phase, children. The income method, the second phase, and the expenditure method, the third phase. Again, I repeat that the three methods are the three angles of looking at the flow of national income. The circular flow of national income has helped us in understanding it. We begin with the first phase of national income accounting, that is the production phase or the value added. When you use the term value added, what does it mean? Value added measures national income in terms of value addition by each producing enterprise in the economy during an accounting year. Value added, in fact, is value added to the intermediate product. It is the difference between value of output of an enterprise and the value of intermediate consumption. Let's understand it with the help of an example. As you can see on the screen, we have a schedule with the heading Estimating Value Added. This is the value added that we are talking about in the value added method of calculating national income. We have four columns. The first column shows the production unit, which shows four production units. They are the sweet seller, the baker, the farmer, and the shopkeeper. Value of output is the second column. Here we calculate value of the total goods that they have produced. So, how do we calculate it? If we know the quantity of output, we can find value of output by multiplying it with the market price. But this value of output also covers the intermediate goods which were used for production. Thus, to find the value added by the production unit, we subtract the intermediate consumption from value of output so that we get the value added by that particular firm. In the given series of examples, we have the sweet seller who makes a value addition of 500, the baker also 500, the farmer 1500, and the shopkeeper 400. So in this hypothetical economy where there are only four producers, the sweet seller, the baker, the farmer, and the shopkeeper, the total value added within the economic territory of the economy is worth 2,900. That is, this economy's gross value added at market price is 2,900, which is also called as gross domestic product at market price. This value added by producing enterprises within the domestic territory of a country during an accounting year is called gross value added. Having estimated gross domestic product at market price, we find out net national product at factor cost by subtracting depreciation, net indirect tax, and adding net factor income from abroad. This was about a hypothetical economy with only four producers, but in reality, there are n number of firms. So, how do we calculate them? It seems so very difficult, almost impossible, to first identify these production units, calculate values of goods that they have produced. It seems maddening. Here the economists have formulated a strategy which makes it possible to calculate national income by all the three methods. Let's look at it. In reality, the economy has a large number of production units. Indian economy, for example, has millions of production units. It has been a standard practice to classify the different producing units as primary, secondary, and tertiary sectors of the economy. While primary sector is dominated by the agriculture, secondary sector is largely taken as industrial sector, and tertiary sector includes all types of services connected to the value addition. Now, You can see on the screen, we have a flowchart which begins with a red box which shows the value added of primary sector plus value added of secondary sector and the value added of tertiary sector. Addition of all the value added belonging to these three sectors, we get gross value added at market price, which is also called as gross domestic product at market price. That's the yellow box in front of you that I'm talking about. Once we get gross domestic product at market price, we subtract depreciation to move from gross to net. We again subtract net indirect taxes to move from market price to factor cost. Consequently, we get net domestic income at factor cost, to which when we add net factor income from abroad, we get national income, NNP at factor cost, the last box given in the flowchart. It shows NNP at factor cost, that is the national income. Summing up, value added by all the production units of all the sectors of the economy, we can get value added by the economy as a whole. The value added by the economy as a whole is called gross domestic product. Accordingly, the sum total of gross value added at market price of all the sectors is equal to gross value added at market price, that is GDP at market price. So, we have seen that we find value added by deducting intermediate consumption from value of output. We have also seen that if we know the quantity of output, we can find value of output by multiplying it with market price. But the practical problems do not make our task easier. Business accounts do not give this information directly. We have to use other information in the account to find the value of output. Let's see how. Business accounts give information about sales, but what about that part of output which is produced but not sold? It is in fact added to the closing stock. But closing stock also contains unsold output of the previous year. The opening stock is actually value of unsold output of the previous year. Therefore, by deducting opening stock from the closing stock, we get unsold output of the current year. And by adding it to sales, we can get the value of output of the current year. Thus, value of output is equal to sales plus closing stock minus opening stock. By deducting opening stock from closing stock, we get change in stock. Therefore, value of output is equal to sales plus change in stock. Now, let's see what are the precautions to be taken in estimating national income by value added method. Here, precautions mean if you do not adhere to these points as we will be discussing now, it would lead to overestimation of national income by value added method. Let's discuss the first problem, that is the problem of double counting. This problem of double counting is very important from conceptual point of view because it forms the basic of calculating national income via value added method. It is also very important from examination point of view because it's been seen that questions of 6 marks have been asked in the board exam on what is the problem of double counting and how it can be overcome. So children, let us understand it with proper examples. The schedule as seen on the screen can help us in understanding the problem of double counting and why we need to take value added instead of total output while calculating national income by value added method, or take the value of final output only. So, there are 2 ways in which we can overcome the problem of double counting. The first, we measure the value added instead of total output, and second, we measure the value of final output only. Suppose a farmer produces wheat worth rupees 500. He sells it for rupees 500 in the market to a flour mill owner. For the farmer, value addition is 500 as he does not incur any intermediate cost. The purchase of wheat by the flour mill is an intermediate good. who converts it into flour and sells it for rupees 1,500 to a baker. The flour mill treats the flour as a final good. The baker purchases the wheat flour from the flour mill and converts this into bread. He sells the same to a shopkeeper for rupees 3,500. The shopkeeper sells these bread to consumers for rupees 4,000. Now, as we see in the schedule, the output of farmers, flour mill owner, the baker and the shopkeepers are respectively 500 plus 1,500 plus 3,500 plus 4,000, which is equal to 9,000. But this is not the value of actual physical output, because this includes the value of wheat 4 times and value of bread twice. This leads to overestimation of national income. To avoid this problem of double counting, we take value added instead of total output. For this to happen, it is first necessary to identify intermediate consumption. In an example, the intermediate consumption of the flour mill owner, the baker and the shopkeeper together accounts to 5,500. When we subtract this intermediate consumption, that is 5,500 from 9,000, we get the value added of 4,000, and this is the value that is to be counted while estimating national income, because this is free of double counting. The second way of avoiding the problem of double counting is to take the value of final products only. Final products are those which are purchased by consumption and investment. In an example, the value of output only by the shopkeeper, that is 4,000, is final product, because he alone sells his entire output to the consumer. This equals the value added by all other production units taken together. So, by taking the value of final products only, we can avoid the problem of double counting. This method of avoiding double counting is used in the expenditure method of estimating national income. Other precautions to be taken while calculating national income by value added method are: value of the sale and purchase of second-hand goods is not included in the estimation of value added or GDP, because value of second-hand goods is already accounted for during the year they were produced. Next, own account production of goods of the producing unit is taken into account while estimating value added, because these goods are like those produced for the market. They are simply not sold owing to the need by the producers themselves. Example, cars used by the car producers for transporting their employees. Next is the imputed value of goods produced for self-consumption, which is taken into consideration. Again, because these goods are like those produced for the market. Example, wheat produced and consumed by the farming families themselves. Children, keeping these precautions in mind and the concept of calculation of national income by value-added method, let's apply them and solve the question. As we can see on the screen, a numerical which states the data about the firm X for the year 2000-2001. Let's calculate the net value added at market price. A series of data is given with figures. They are sales, closing stock, opening stock, indirect taxes, depreciation, intermediate consumption, purchase of raw material, and rent. To solve, from where to begin? So we need to first analyze the data given to us and then think from where to begin. The first thing that we need to see within the particulars given to us in the question is how to calculate value added. In order to calculate value added, we need to identify value of output and intermediate goods. Value of output is nothing but sales plus change in stock, from which when intermediate good is subtracted, you get value added. That is gross value added at market price. It is also called as gross domestic product at market price. Once you get gross domestic product at market price, we can now calculate net domestic product at market price by subtracting depreciation from gross domestic product at market price. By doing so, we get the answer 40 crores. So children, we will next meet with a series of questions based on value added method in your assignment. Till then, bye and take care.